Hi, my name is Shrikant. So as you can see from the title, this video is going to be about income tax provisions relating to agriculture income, or how to levy income tax on agriculture income. So without wasting any further time, let's get started. The first and the foremost important thing which you have to know about agriculture income is, as per section 10 subsection 1 of the Income Tax Act 1961, agriculture income is exempted. That means if you earn any agriculture income, you need not pay any income tax on it. Your agriculture income is free from income tax. However, though your agriculture income is exempted from income tax, but in order to determine the rate at which your non-agriculture income is to be taxed, you have to take into account your agriculture income also. I'll explain you more about this part in detail a bit later in the video, but for the time being, just remember that agriculture income is exempted. So if you want to make agriculture income, you have to perform agriculture. So it is important to know the meaning of agriculture within the context of income tax. But unfortunately, the Income Tax Act doesn't define the term agriculture. Whenever any act, that is a particular statute, is not clear on something, you're allowed to refer to relevant decided case law. So as per the Supreme Court's decision in the case of CIT versus Raja Binoy Kumar Sahas Roy, it was held that income derived from basic and subsequent operations bear the character of agriculture income. Examples of basic operations are tilling, sowing, planting, etc. Whereas examples of subsequent operations are weeding, spraying pesticides, tilling, pruning, and harvesting. So as per the Supreme Court's decision, agriculture is divided into basic operations and subsequent operations. And on the basis of the examples that are given, it's quite clear that basic operations are those operations which are compulsorily required for growing an agricultural crop. Whereas subsequent operations are those operations which are not compulsorily required for growing an agricultural crop, but are pretty much essential for maintaining the quality of the crop. For example, even if you do not spray pesticides, you can still grow an agricultural crop, but its quality will be pretty bad. It is important to differentiate between basic operations and subsequent operations, because the Supreme Court has also stated that a mere rendering of subsequent operations alone shall not be considered as agriculture. That means before you can actually perform subsequent operations, you should have already performed basic operations. As per section 2 subsection 1a, there are three types of incomes which are covered under agriculture income. But before I explain what those incomes are, it is extremely important to note that the agricultural land has to be situated within India. If the land is situated outside India, then the income derived from it shall not be considered as agriculture income, even if you perform agriculture on it. So the first type of income which is covered under agriculture income is rent. If you have an agricultural land and if you give it on rent to someone, and that someone, that is your tenant, uses it for agricultural purposes, then the rent which you receive from him shall be considered as agriculture income. And that rent may be in cash or in kind. In either case, it will be considered as agriculture income. The second type of income which is covered under agriculture income is sale of agricultural produce. Whatever the income which you earn by selling your agricultural produce shall be considered as agriculture income. And also, many times, it might not be possible for you to sell the agricultural produce as it is. You might be required to employ certain process on it before you can actually sell it. Examples of such processes are cutting, drying, packing, etc. Any income generated from such processes shall also be considered as agriculture income. However, please note that such process should only make the agricultural produce fit for the market, but it shouldn't bring into existence an altogether different product. The third type of income which is covered under agriculture income is income from a farm building. Income from a farm building shall be considered as agriculture income provided four conditions are satisfied. The first condition is the building should be situated on the agricultural land or in the immediate vicinity of the agricultural land. That means either the building should be situated on the land itself or in the immediate vicinity, that means in the immediate proximity of the agricultural land. The second condition is the building should be occupied by the cultivator or the receiver of rent. That means the building should be occupied by the cultivator himself, or if it is given on rent, it can be occupied by the owner also. The third condition is the building should be used as a storehouse or an outhouse or a dwelling house. Dwelling house means a house which is used for residential purposes. The fourth condition is the land should be assessed to land revenue in India, or it should not be situated within the specified area. That means either the land should be assessed to land revenue in India, or it should not be situated within the specified area. If all these four conditions are satisfied, then the income from a farm building shall be considered as agricultural income. As I just said, the agricultural land has to be situated within India. If the land is situated outside India, then the income derived from it shall not be considered as agricultural income, and it shall be charged to tax under the head profits and gains of business or profession. However, one important point here is that usually when the agricultural land is situated within India, and if you incur any loss on it, then such loss shall not be allowed to be set off or carried forward, since the income is exempted in this case. But if the agricultural land is situated outside India, and if you incur any loss on it, then such loss shall be allowed to be set off or carried forward, since the income is not exempted in this case. Any profit derived by selling an agricultural land shall not be considered as agricultural income, but it shall be charged to tax under the head capital gains. However, as per section 2 subsection 14, if the agricultural land is situated outside the specified area, then it shall not be considered as a capital asset. So if the agricultural land is situated outside the specified area, capital gains shall be exempted. Instead of directly selling the agricultural produce, if you utilize it as raw material for your business, then the market value of such agricultural produce shall be allowed to be deducted from your business income. For example, if you utilize sugar cane for the production of sugar, then the market value of sugar cane shall be allowed to be deducted from the business income of sugar. But in case such raw material is used in the case of rubber, coffee and tea, the tax treatment will be in accordance with this table. For example, in the case of rubber, 65% of the income shall be considered as agricultural income, which shall be exempted, and the remaining 35% of the income shall be considered as business income, which shall be taxable. You might have noticed I have used the term specified area in the case of income from a farm building and transfer of agricultural land. So you are required to know the meaning of specified area. Any area shall be considered as specified area provided two conditions are satisfied. The first condition is it should be situated within the jurisdiction of a municipality or a cantonment board. The second condition is it should have a population of not less than 10,000 according to the last preceding census. If both these conditions are satisfied, then it shall be considered as a specified area. However, if the first condition is not satisfied, that is, if it is not situated within the jurisdiction of a municipality or a cantonment board, then it can still be considered as a specified area provided it satisfies any of the conditions specified in this table. For example, if it has a population of more than 10,000 but not more than 1 lakh, then it shall be considered as a specified area provided it is situated within a distance of 2 kilometers from the limits of a municipality or cantonment board. As I said in the beginning of the video, though your agricultural income is exempted from income tax, but in order to determine the rate at which your non-agricultural income is to be taxed, you have to take into account your agricultural income also. This is called as aggregation of agricultural income. So whenever you earn agricultural income, this is how you need to find income tax payable. Step 1. Add agricultural income and non-agricultural income. Step 2. Add agricultural income and basic exemption limit. Step 3. Find income tax payable on the amount arrived at in Step 1. Step 4. Find income tax payable on the amount arrived at in Step 2. So the net income tax payable shall be the amount arrived at Step 3 minus the amount arrived at Step 4. However, if the agricultural income does not exceed Rs 5,000 or the non-agricultural income does not exceed the basic exemption limit, then such aggregation need not be done. So that concludes income tax provisions relating to agricultural income. Thank you so much for watching. I will see you again